This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This is the second lecture on the impact of financing. And in this lecture, I want to look at what we call the adjusted present value, which is of critical importance to the exam. It's very, very commonly asked. And let me explain what it is. It's actually pretty straightforward, as you'll see, but it is important. In previous lectures, when we were appraising an investment, we set up the cash flows, and that's not going to change at all, what we're about to do. But we then happily discounted at the weighted average cost of capital. Now, I said at the time, and I said again in the first of these two lectures, our problem is if we change the gearing in order to finance the project, then that's going to change the weighted average cost of capital, which gives us problems. And in fact, if there's anything other than a minor change of gearing as a result of doing a new investment, we don't use the weighted average cost of capital. A far, far better approach, if there's a major change in gearing, is what we call the adjusted present value. So this applies when there's a big change in gearing, although in fact the question is, what's a big change? The examiner, I've said this is very, very common, but almost always he specifically tells you that he wants an adjusted present value approach. He doesn't leave it up to you to decide, is it a big change in gearing or isn't it? You know, what's big? And the approach we take is very much Modigliani and Miller, to be honest. That's where it comes from. Because remember, I did say in the previous chapter, and you have heard before, that if there was no tax, then it would be irrelevant how you raise the finance. Using debt would be exactly the same effect as using equity. So, you know, whether it was financed entirely from equity or whether you used lots of debt, if there was no tax involved, you'd get the same answer. There is tax, of course, but what difference does it make? The only reason that the debt makes a difference when there's tax involved, the only reason is because you get tax relief on the debt interest. If it wasn't for that, it wouldn't make any difference whether you financed it all from equity or in lots of debt. And so what we do with adjusted present value, as you'll see, is we first of all calculate the NPV as though the project or the investment was all equity financed. So initially, forget the gearing and say, well, if we're not using any debt, if it was all financed from equity, what would the NPV be? And we say, but we are using gearing, we are using some debt. Why does that make any difference? Simply because we get the tax benefit on the interest. And so we then add the tax benefit, so I've got the tax shield. We add the tax benefit on the debt raised. We add the two together and we call the answer the adjusted present value. You know, if it's positive, it's good, if it's negative, it's bad, and so on. So that's what it is. Don't use weighted average. Work out the NPV. Set up the cash flows exactly as normal, whether they're easy, whether they're messy. But when you come to discount first of all as though it was entirely equity financed. and then separately add on the tax benefit that we get from the debt raised. Let me show you what I mean with example 2. It's a terribly simple project. It wouldn't be this simple in the exam, but we spent enough time setting up cash flows earlier, and that side of it doesn't change at all. So the project here has the following after-tax flows: 100 million outflow, and then a receipt of 40 million a year for 5 years. So it's the simplest project you could see, but I repeat, however complicated the project flows were, inflation, tax, everything, that's the same as what we were doing earlier. There's no extra complication on that side. So these are the final net cash flows. A cost, an outflow of 100 million, followed by net inflows, net cash inflows. Oh dear, what's wrong with my spelling today? Net cash inflows of 40 million per annum. So there are final net cash flows before discounting. The asset beta of the project is 1.5. Well, think back to the capital asset pricing model chapter. How would you have found that? Maybe you were just given it in the exam as here. Otherwise, you'd look for a company in the same business as this project, and you'd calculate their asset beta. But either way around, we know the asset beta is 1.5. The market's giving 15, the risk-free rate is 5. Corporation tax is 30%. Well, let's do the 2 steps I outlined. First of all, we are going to calculate the NPV as though it was all equity financed. Well, if it was all equity, all that's relevant would be the beta of the project. The beta is 1.5, it's its asset beta. But if it's all equity, the equity beta is the same as the asset beta. The only difference is because of gearing. If it's all equity financed, then what will the cost of equity be? We'll use the asset beta because equity beta would be the same. And using the normal formula, it would be the risk-free 5 plus beta 1.5 times the market premium, 15 as against 5. It would be what? 15, it would be 20%. And so we'd simply discount the project at 20%, and at 20%, 100 million now is 100 million. The inflows, I'm sorry, my tables are all over the place. We have an annuity, 5 years, 20%. So the annuity factor, 2.991. The present value of the inflows, £119.64. The NPV. So part A, if it was entirely equity financed, that would be the NPV. That effectively would be the gain to the shareholders. They're paying out 100, they're getting something worth 119. They're going to gain 19.64. What about B? Here's where we come on to adjusted present value. This time it's the same project, exactly the same, but we're going to finance it using gearing. 70% of the finance will come from shareholders. We need 100 million, so they'll give 70 million. The other 30% will come from debt, irredeemable debt. Well, as I said when I started this, assuming that's a major change in the gearing, we'll take an APV approach. And for the APV, step 1, the MPV if all equity financed. Call it the base case MPV, but that doesn't matter. Well, again, if it's all equity financed, forget the gearing. The relevant beta is the asset beta of the project, 1.5. Shareholders would be requiring 20%. We discount at 20%. If it was all equity financed, the MPV would be 19.64 million. We use some of the finance is coming from debt. And again, if there was no tax, it wouldn't make any difference. Things would stay exactly the same, nothing would change. But according to Modigliani and Miller, the reason debt is an extra benefit is because of the tax relief on the debt interest. How much debt interest are we going to be paying each year? Now listen very carefully here. The debt interest we'll be paying each year, we're raising 30% of the finance from debt. So 30 million is what we're raising. How much interest will we be paying each year? Well, it depends on what interest rate you're given. If you're told that the debt's being raised at 8%, the interest will be 8% of 30 million. Here we're not told. We've no choice but to assume it's being raised at the risk-free rate. And so the interest each year will be 5%. The benefit is the tax we'll save on that interest. And so, if we're paying 5% of 30 million a year, the saving each year, the tax rate's 30%. As a result, we'll save 35%. We'll save 0.45 million per annum. Well, what we need is the present value of that saving. So we'll save 0.45 million a year. It's going to be, it says here, it's irredeemable debt. And so that's going to be the saving every year in perpetuity. And how do I get the present value? We discount by 1 over the interest rate. Well, what's the interest? The risk-free rate is 5%, so 1 over 0.05. The present value of the tax saving, 0.45 million divided by 0.05 is 9 million. So it's those two steps. What's the MPV if it's all equity? 19.64. In addition, the present value of the tax relief on the debt interest, 9 million, total 28.64 million. There is the adjusted present value. There is the gain to the shareholders. They're gaining 19 million because it's a good project, even if they financed it themselves. They're gaining another 9 million because they're getting the benefit of this tax relief. The total benefit, 28.64. Well, for part B, the debt was irredeemable, but of course, could be in the exam, but in real life, it's not going to be. And so let's look at part C, where again, it's financed 70% from equity and 30% from debt, but this time, it's redeemable debt. We're only therefore going to get the tax relief for 5 years. Again, exactly the same. The base case MPV, the MPV if all equity financed. was 19.64 million. And again, the only reason that debt will make a difference is that the fact we've raised debt means we'll be paying interest and get tax relief on the interest, which you wouldn't have got on dividends. We've got that extra benefit. So the tax benefit on the debt. Again, assuming, with no choice here, but to assuming the debt, we're paying the risk-free rate, the interest is 5% on, again, they raise 30%. So that's the interest each year. It's the tax saving on the interest that matters. And so again, the tax saving, just like before, will be 0.45 million. The only difference, instead of being irredeemable and therefore in perpetuity, we'll only get that tax saving here for the 5 years until the debt is redeemed. We need the present value of the tax saving. Well, it's an annuity, discount at the 5%. And the annuity factor, 5 years at 5%, 4.329. The tax benefit this time, or the present value of the tax benefit, 1.95 million, if I keep to do decimal places. Which clearly is a lot less than it was before. What was it before? 9 million. Clearly a lot less because we're only getting the tax benefit for 5 years as opposed to in perpetuity. But as a result, the APV in this case would be 21.59 million. That'd be the benefit to the shareholders. 19.64 because it's a good project. They'd get that even if they provided all the finance. But an extra 1.95 million because raising debt is beneficial because of the tax benefit. Now, just one thing that's important, and I said listen carefully earlier, and it's actually this bit you need to listen carefully to. The interest depends on, this is new debt we're issuing, so it depends on the coupon rate. I had no choice here but to assume, as you would in the exam if there was no other information, we assume that debt was risk-free and therefore the coupon rate would be 5%. But if I had have told you in the question that the debt was issued at a coupon of 8%, fine. You'd have said the interest is 8% of 30 million, tax saving 30%, a different figure, no problem. However, when it comes to discounting, the tax benefit, well, there are two rates you could use, and there's good arguments for either. You discount at either the risk-free rate or the pre-tax cost of debt the return to investors, which in fact, when it's new debt, will be the coupon rate. Now you can discount at either. It gives different answers, but the examiner always accepts either answers because there's an argument for using both of these. You see, the rate we should use for the discounting the tax saving depends on how risky the tax saving is. And one argument is to say, well, the tax saving is certain, it's fixed. Use the risk-free rate. The other argument is to say that the tax saving will carry the same risk as the debt itself does, and so discount it at the coupon rate on the debt. Now, I hope I'm making that clear. Here, of course, the two are the same because we weren't told the coupon rate. We assumed it was risk-free. But if I had have told you that the debt is being raised at 8%, then that the interest would be 8% of 30 million, the tax saving would be 30% of it. But when you came to discount, you could either discount at 5%, the risk-free rate, or you could discount at 8%, the return on debt. As I say, although they give different answers clearly, the examiner always makes it clear in his answers that he would accept either rate. Either of them gets full marks. Because, as I say, it is debatable which is what you might call the better rate to use. But there we are. You see, on its own, it's very, very easy. But okay, a full question one, it would have taken you ages to get the net cash flows in the first place. But we spent enough time on that before, and getting the cash flows isn't affected at all. It's the same problems. But, you know, it could be investing abroad, and you've got inflation, you've got tax. Because it's abroad, you've got those foreign exchange rates, and so on and so on. When you come to discount at the cost of equity, if it's all equity financed, you need the asset beta. If you're lucky, you're given it. Otherwise, there'll be information about a similar company, and you'll have to take their beta and ungear it. We've done all that. So it can end up being a very long question, but the actual APV part of it, I don't think that is terribly difficult. You'll see below, finally, two extra things that could be brought into the question. We're doing a new project, we're raising finance. There could be costs of issuing that finance. You could be told, you know, we're raising 100 million, it'll cost 1 million to raise the finance. Well, I think you'd accept if I told you it cost 1 million to raise the finance, the final APV would be 1 million lower. You know, you simply deduct any issue costs. Quite often they have what we call subsidized loans, where perhaps we're taking a loan, perhaps the normal rate of interest is 8%. But maybe we're investing in a foreign country and they say they'll subsidize and we'll only have to pay 5% instead of 8%. No problem. If somebody gives us a cheap loan, the subsidy is another benefit. If you only paid 5% instead of 8%, you have an extra benefit of that 3% interest. So both of those last two are just following instructions, no big problem. The important bit is the appreciation of what APV is. And read questions carefully. As part of the requirements, an examiner wants APV. He'll specify it in the requirements. He'll either say calculate the adjusted present value, or he spells it out. Calculate the present value as though it was all equity financed and then account for the tax benefit. Well, again, that is APV.